Hello students, welcome to final session of mathematical theory of interest course. This is the last lecture and in which we will continue our discussion from day 23's topic, which was interest rate and sensitivity of the interest rate. We discussed in the last session, we discussed what are the important components of the interest rate, what are different factors that may affect the rate of interest to increase or decrease in future. Then we discussed how the time value of money will be affected due to changes in the interest rate. Today we will continue our discussion further, and in today's session we will discuss more about the interest rate risks and what are the types of the interest rate risks, effects of the interest rate risk, measurement of the interest rate risk. We will discuss about different strategies for controlling interest rate risks and Basel committee recommendations. Then we will discuss about the sound interest rate risk management and what are the important practical aspects of the interest rate. All these things we will discuss in today's class. As we discussed previously, it is basically for interest rate risk is basically it is the potential loss from the unexpected changes in the interest rate, which can be significant after a bank's profitability and market value of the equity. In the possibility of losses due to changes in the interest rate, it will be called interest rate risks. It is basically the amount at risk is a function of the magnitude and the direction of the interest rate. And when the interest rate rises, the cost of funds will increase. Here are different types of interest rate risks. Normally, they will affect the rate of interest. First of all, repricing risk, then basis risk, then yield curve risk, then embedded option risks. Repricing risk. Basically, it arises on the account of mismatches in the interest rate. The interest rate on different kinds of securities will change due to changes in these interest rates. The repricing risk will arrive, and it can be measured by measuring the risk of different types of buckets. For that purpose, we need balance sheet on and off on a particular date, and we need a business plan and expected income from that company. Here is then, for example, here we have given the balance sheet on a particular date, and we have calculated the return on investments for scenario 1, scenario 2, scenario 3, and asset sensitivity in scenario 4. Then on the other side, asset side, we have fixed rate, we have for 91 days, we have fixed rate which is 11% for 91 days. Based upon this information, we can calculate our basis risk, which is the interest rate on assets and liabilities that do not match in the same proportion. When interest rate was raised by 2%, PLR will also raise by 1% and deposit rate will increase by 1.5%. So therefore, we can say that the basic risk raises when interest rate of different assets and liabilities change in different magnitudes. They change in different magnitudes. Now here are some more examples of how we can calculate the option risk or the interest rate risks. Next one is the yield curve risk. What is yield curve risk? We discussed in detail yield curve. Yield curve is the relation between interest rate or cost of borrowing and the time to maturity of the debt for a given borrower in a given currency. the risk caused due to change in the yield curve from time to time depending upon the repricing and various other factors. A yield curve basically is it it tell it is basically the shape of the yield curve is basically tells us the relationship between interest rate and the cost of borrowing and the time to maturity. Interest rate and time to maturity, the curve which shows us the relationship between time to maturity and the interest rate is called yield curve. And normally the yield curve is sloped like it has an increasing trend at a very high rate at the start, and then the rate of increase will become smaller and smaller and smaller. Higher the time to maturity, higher will be the yield curve. But for a very longer time, the rate of interest will become almost constant. What is yield curve risk? Risk of experiencing an adverse shift in the market interest rate associated with investing in a fixed income instrument is basically it is the yield curve risk. The adverse shift, instead of increasing, when the yield is started decreasing, it is referred to as yield curve risk. Here's a practical example of the yield curve risk. You can just go through this example by yourself. If you understand it, it's better. If you don't understand, it's okay. This is just for your explanation, for your understanding, for your information. Is the impact of interest rate volatility on the net interest income. There are different approaches to measure the internal rate of return or interest rate risk. There are 4 different approaches: maturity gap analysis, duration gap analysis, simulation analysis, value at risk. These are basically, we can say that these are the sensitivity analysis for measuring the interest rate risk, IRR. MGA, maturity gap analysis. Maturity gap analysis basically distribute interest rate sensitive assets, liabilities and OBS position into a certain number of predictive time bands according to their maturity. And the gap is basically gap is basically then accumulated by the end. The gap is accumulated by considering the difference between absolute values of relative sensitive assets, risk sensitive assets, and absolute values of the sensitive risk liabilities. The difference between sensitive assets and sensitive liabilities with respect to risk factor will be the gap. So here are 3 different options. First of all, if RSA is greater than RSL, we will have a positive gap. When assets are lesser than the liabilities, the gap is negative. When they are equal, it will be called as a zero gap. Here practically we can say that this is the maturity gap analysis. In that particular case, we have RSA which is 2800, RSL which is 1800, then the gap will be 1000. Here is another example just for your understanding for in case of a zero gap. So we can say that there are 3 different kinds of scenarios, and according to these scenarios we can plan differently. We can have different kinds of strategies. First of all, in case of rising interest rate, our strategy should be to maintain a positive gap. In case of declining interest rate, we will try to maintain a negative gap. And for uncertain situation, which is not clear, either the interest rate is increasing or interest rate is decreasing, then we will try to maintain a zero gap, and we will try to work on break-even point. with no benefits. Here are some factors that affect net interest income. In this example, we can say that it is the expected balance sheet for hypothetical bank. We have rate sensitive assets, we have fixed rate assets, we have non-earning assets. And again, on the other hand, we have rate sensitive liabilities, fixed rate liabilities, and non-earning liabilities, and we have equity. So we can calculate the NII, NIM, and GA gap between the assets and liabilities. Here are some factors that may affect net income, net interest income. First of all, with the changes in the level of interest will also affect net interest income. The composition of the assets and liabilities, the volume of earnings, assets, and interest bearing liabilities will affect the net interest income. For example, we can see that a 1% increase in the level of a short term rate will affect how much the net interest income, how much it will have a net interest income. These will be the possible questions that we need to answer. From this example, we can easily get with 1% increase in short term rate, how much it will affect the gap, how much it will affect the gap. So finally we can see that it will affect by 4.74%. 4.74%. Here is how you can find out the maturity gap method. In maturity gap method, basically RSG will be equal to RSA and RSLs, and we will calculate the gap ratio by dividing assets and liabilities, and NII will be equal to gap multiplied by R, and this triangle will be, it can be the rate, the change in the interest rate, or the change in the net interest income. Net interest income. Now next one, here is some more general scenario about the mathematical expression of the maturity gap method. You can just read down the chapter, then you will better understand the whole scenario. The maturity gap, in this example, although it looks a little complex, but if you will study, if you will read out the chapter, then you will have more better understanding about these concepts. Now I will quickly move on. This is basically the balance sheet which we looked at from interest rates point of view, whether they are bearing interest, fixed or floating rate, and according to their position, what should be the possible conditions or remarks. For example, capital is basically not interest bearing part of the balance sheet. Reverse and reserves and supplies, again it is non-interest bearing. Deposits, current deposits are non-interest bearing, while on saving deposits they are interest bearing, and the interest will be fixed in case of saving accounts. Similarly for term deposit from within India, from outside India, this is just an example from India. You can take any example. From this table, you can get a clear idea about the IRS and the interest rate scenarios. It assumes that changes in interest rate immediately affect all RSA and all RSLs. Next one is the duration gap analysis. A duration gap analysis, it is a measure of percentage change in the economic value of a position that occurs giving a small change in the level of interest rate, and basically it concentrates on the price risk and the reinvestment risk while managing the interest rate exposure. By managing the interest rate exposure, it also measures the effect of rate fluctuations on the market value of the assets and the liabilities and NIM with the help of duration. Here is a practical example of the duration gap analysis. You guys go through this example by yourself. Uh, Basically, this chapter, this part, will be a bit harder for you to understand, and this is for your interest, for your better understanding or for your easiness. I will skip this chapter from your final exam because this is not a regular semester. So lastly, about the simulation, what is it? Simulation performs under alternative interest rate scenarios and assesses the resulting volatility in NII and NIM, ROA, ROE, and MVE. It's basically a financial model which is incorporating interrelationship of assets, liabilities, prices, cost, volume, mix, and other business related variables, and the computer generated scenarios about future and response to that in dynamic way. And the data requirements of the simulation are basically the maturity and repricing rate scenarios, alternative management response under different scenarios, yield curves. These are the data requirements to conduct a simulation analysis. And simulation analysis, regarding other information about the simulation analysis, they include the risk return policies. They are useful in regulatory frameworks. They are useful in capital strength and profitability analysis and experience and track record management, and so on. Here are some advantages and disadvantages of the simulation procedure. So internal rate risk management, basically it's a cycle starting from the model, then we deploy the model, then we monitor the model, then we conduct a analysis of the whole information that we have gathered. Then we have to work according to the direction we will receive from our analysis. Again, we will start this model. We will start to develop this model. This cycle will, or this process will continue. The interest rate risk management, it basically, in interest rate risk management, we by using the earning simulation. For every kind of measure, we have different kinds of strategies. For example, in case of a long-term exposure, we will need gap report. We will need, but earning simulation is limited in that particular case. And yes, we have economic variation in case of a long-term exposure, because in long-term exposure, the interest rate risk is more prominent as compared to short-term investments. There are certain benefits of the interest rate risk management. It defines financial targets based upon corporate tax risk tolerance. It reduces earnings volatility. It improves cash flows forecasting. It improves corporate ratings, credit ratings, and it defines risk management and hand methodologies. So finally, this is all about our today's topic. And in this today's topic, we have discussed that there are different kinds of interest rate risk management techniques. Based upon the quality of the interest rate risk and the quality of interest rate risk management, we can evaluate the adequacy of the bank's capital by determining the component rating for sensitivity to the market risk. And we have also determined the further effect of interest rate and earnings on the business in microscopic view. This is all about our today's discussion. I hope you have enjoyed the lecture. Thank you so much. Bye bye.